The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
Welcome back to another edition of the Daily Dots. Chase rolling solo with you. Zach is currently in flight on his way back. I'll go through the markets and have a few things to touch on. I think some good stuff today. So, as I've kind of mentioned, we're going to stay pretty close within 100, 200 points of 6,000 until OPEX next Friday. Another quiet day in the market. S&P up 0.38. NASDAQ 100 up 0.23. Small caps down 0.4. So small caps have showed some relative strength here lately. Not today. Equal weight was up 0.23. Mag 7 down just a little bit. All world ex-US was up 0.58. You had oil up 0.67. Gold up about 1.9. Silver up 0.4. Platinum up another 2 and change. You're up close to $1,300 on platinum now. It's up like 40% in a very short amount of time. The dollar, probably the biggest story of the day. Dollar down 0.72 to 97.87. So just I think I mentioned yesterday or day before, like, or maybe even Monday. It looked like you were kind of putting in another bear flag, and we're very likely to have kind of another break lower, and that's exactly what we got. Another break lower. And on the dollar, you are now, let's see. So you're below the prior low of this year, and you have to go all the way back to 2022 to get to where you were this low. And importantly, the dollar is off to its worst first half start of a year. So the first 6 months of any year since 1974. And for those scoring at home, that is 51 years. So you're talking a half century of data, and you're coming in below that. So that's a huge deal. Dollar incredibly weak year to date. That's not new. It's not news really, but I think that 1974 numbers probably catches some folks off guard. We still have another 6 months to go after the next couple weeks, so who knows what happens. But for now, the dollar looks rough, and some of the stuff I want to talk through here in a bit, I think, helps illustrate, why we're in that position. 2-year yield was down about 4 basis points, and very notably today, the long end was down a good bit as well. You had the 10-year yield down 5, and more importantly, you had the 30-year down about 7 basis points. 30-year had a good auction today. But we've had a lot of days in recent weeks, really, where the 10-year would have a decent rally, and the 30-year just really wouldn't join in. So the fact that the 30-year not only did join in today, but even more aggressively than the 10-year, I thought was notable. With that said, speaking of the first half of the year, we have not closed a quarter above 4.8% on the 30-year yield since, I think it's 2007. And we're still above that by about 4 or 5 basis points with, 2-ish weeks to go in June. So I'll be definitely keeping a very close eye on how that plays out. Despite the market being up today, you did have vol up. Front month VIX futures are actually hovering around 20 with spot VIX at about 18. So a little bit of a pickup in vol here very lately. I think, you probably just people buying some protection given the news out of the Middle East, and some of the rumors around not just what's going to go on with Iran, but also some of this volatility around trade that continues in the headlines. So what I wanted to talk about first was the dollar, and I'll add a couple things to the fact that the dollar is incredibly weak so far. One is, I think that's going to be good for earnings. It's going to be good for tech earnings. and I've said on the show before, but we've gotten to a point where I think earnings expectations for 2025 are actually too low, and it's very uncommon for me to feel that way. Usually, I look at what analysts are looking at for earnings, and I'm usually I just scratching my head and can't figure out how we're going to get up there. Right now, I look at 7% full year earnings expectations, and I don't really understand how we're going to be that low. And I think the dollar helps with that, with all the overseas earnings for tech especially. But that's kind of the good part. The bad part might be if the dollar keeps going the way it's going, you eventually get to a point where it actually start to import a little bit of inflation just out of currency weakness. Now, not substantial. I'm not saying we rip back to 4 or 5% inflation just because of the dollar falling. But, if you get back to 3 and say, 20 basis points of that, 0.2% of that 3% is kind of just currency weakness. Like that's not nothing that could be important. So couple things to keep in mind with dollar weakness. Probably helps with earnings, may not help with inflation. Yesterday I said today would be important to watch jobless claims. That has been a little bit of a yellow light lately, and today was going to be important to see if we stay yellow, if it starts to get better, go back to green, maybe even inch toward red. And I would argue we're inching toward red. Still not there, kind of an orange color. But you had another bad day, worse than expected again for initial claims, and then more to the point, continuing claims. That's people that are unemployed looking for work. That number is kind of suddenly going straight up and broke out of a long consolidation period, which is suggesting that the labor market is definitely weakening. And in the last few weeks, not just from last year or whatever. And you can see that in multiple areas of data at this point, to include income tax numbers that are provided weekly by the Treasury, or technically daily. So that gets more and more attention from me as we move forward. Another thing I wanted to talk about that I somewhat surprisingly haven't really talked about on the show is that's Section 899 in the reconciliation bill. Very controversial. No one seems to agree on even what it says or means. But in effect, it is a tax to be paid by foreign companies, foreign people, if they're from a country that is doing a tax to Americans that we deem unfair. The big example from this, one of the main targets, is the digital services taxes that other countries put on our usually tech companies. So if you think about a Google or somebody like that, they make a lot of money in places, European countries, but they don't have any physical infrastructure there. So they technically don't owe any tax. They're making tons of money off their population, pay no tax. Naturally, if these countries in Europe look at that and be like, well, that's not fair. If they're going to do business here and make a bunch of money, like they should pay some tax. But because they're not physically located there, they had to do special carve outs to do these digital services taxes where they can kind of meter usage in a different way, meter income in a different way, so that they can tax it a little bit. And honestly, I do mean a little bit. They're relatively low rates. It's kind of like what we've seen in some states already where, we have a gas tax and then people switch to EVs in the States. Like, well, that doesn't seem right, that if you, just because you have an EV, like you don't have to pay a gas tax, which we're using to rebuild the roads. Like EVs use the roads too. So let's start taxing mileage. It's kind of a similar concept where the usage and the burden is there, so the tax should be there. We're pushing back on that. We want Europe to just go get rid of all these digital services taxes. We view them as unfair. And one of the ways it looks like we're trying to fight back at that is this Section 899 in the bill. Now the Senate is already openly talking about changing it, delaying it. So who knows? And importantly, clarifying what it means, because all these experts are looking at it and no one seems to agree. A lot of people have called for, a little bit more guidance. And this is something Zach's talked about, like how, we have to get back to legislation being legislation and being clear about what happens instead of keeping things deliberately vague, pushing it off to regulatory agencies to kind of write all the rules. And it's like, no. Like you write the rules as they are and then let those people, go run with them instead of make all the rules themselves. This is a perfect example of that. Like, since people already can't agree on what you're trying to get at, what you're trying to say here, like, clear that up. So far, it sounds like the Senate will maybe take that on, which is important. And also, it was set to start at the beginning of 2026. There's rumors that they may push it into 2027. We'll see. But the broader point on Section 899 is this may not be a huge deal, but I think it's a huge signpost, a huge signal for kind of where we're at. This is a bit of an indirect capital control, an indirect, opening up a new front in a simmering capital war between the U.S. and kind of everyone else. And it's not just a U.S. problem. It's like not like only the U.S. is going to have to start doing capital controls. That's going to become unfortunately, I think a mainstay of global economics in the next 20, 30 years, like maybe next 5, 10 years, but where countries with financial problems have to do things to address those and do things that hurt other countries. And it kind of, there's like a scarcity thing here where it kind of becomes everyone for themselves in a sense, in order to, for one thing, just pay down massive debts that many, many countries around the world have. One of the reasons I keep looking for countries with those lower debt burdens, because they don't have to get caught up in this stuff near as much. But Section 899 is definitely something to keep an eye on, as are capital controls in general. I just wrote a giant piece for my clients on capital controls, kind of the history of it, like what they are, how they tend to take shape, how I think they could end up playing a role in the future, and what that'll mean for markets. Kind of a slow burning thing, something that probably won't be a huge deal in the next year, but is the kind of thing that 5 years, 10 years from now, we look back and like, man, that was like kind of all that mattered for markets, you could say. It's one of those things where like you feel like as a society, as a species, like we got through that, like we don't have to go back there. That was like just like a bad dream from 70 years ago or something that all of a sudden is back. Unfortunately, there's a few things like that, but two more things. One, Ted Cruz. I think it was just last week on the show, I brought up the notion that we may get into an inflationary crisis moment where one of the answers is to stop paying interest on reserves with the Fed to the banks, kind of starve the banks of this free money they get from the Fed. And then a couple of days later, next thing you know, Ted Cruz is pitching ending the ability for the Fed to do that, like already now. Forget the inflationary crisis. Let's just do it now. He pitched President Trump this in the Oval Office, and has pitched other senators, you name it. So something I thought might be a thing in 2 or 3 years, already a thing. And I guess he talked about this last week, and I just missed it. I didn't see this until it was yesterday. So that's notable. I don't think that will be imminent by any means. I don't think he can get the votes to really get that through, because he's talking about Congress changing the law on the ability for them to do that. But something certainly interesting. And I think the last thing I'll touch on, what I wanted to leave you with, was I was just reading my buddy Luke Groman's latest piece, and he had some good stuff in there that I wanted to read out, because it sort of fits with kind of the way I've seeing a lot of things lately. And I think it's just really important. He says the U.S. launched the Liberation Day with the Treasury market so fragile that it dysfunctioned just 5 trading days later, when the MOVE volatility index, that's bond volatility index, spiked to 172 intraday, which forced Trump investment to back down. And with a rare earth supply situation so dire, both tactically and strategically, that just 2 months later, the Treasury Secretary, Secretary of State, and President Trump are complaining about China's unfair practice of cornering rare earths that has left the U.S. unable to enter potential conflicts. And that was something that Rubio kind of mentioned. Luke goes on, what are we even doing? How could the Trump administration not understand the bottlenecks of the Treasury market and rare earths before they launched Liberation Day? These moves show either complete ignorance or breathtaking hubris about their operating environment and relative bargaining position. This, if you go back and listen to me, I had a few like these solo shows right around Liberation Day, and I think some folks probably thought I was getting pretty Chicken Little there, but that definitely had me spun up because of this exact thing. Like, it was clear to me that if you actually went through with tariffs at the levels that got presented, you were going to collapse your own economy, you were going to collapse your own financial markets. Like obviously none of that made sense. But at the same time, you could just see the hubris, to use Luke's word here, of a total misunderstanding of our own leverage. Like, and we have plenty of leverage. Like we do have a lot of strength in a lot of areas. Our consumer base is very, very strong and powerful. It's something that countries like China absolutely want it to continue to tap into. So it's not like we don't have leverage. It's just that if you're going to get as if you're going to raise the conflict to the level that we were trying to raise it to back in April, especially against a China that no doubt will be willing to dig in and has plenty of their own leverage, like you're just kind of asking for this. And the rare earth thing is interesting because like China made it real clear, hey, if you guys are going to go do this, like we already made this list of moves that we're going to do to counter you. Like, so, because one of our first moves we did against them was small, and I think it was like the 10% tariff or 25% tariff, whatever. And they like pulled off like one of the metals, I think it was, and that was kind of like a warning shot. In fact, they did three things. They did a tariff, they did a restriction on exports on one of the metals, and they did an investigation into Google. It was kind of a signal, and I think I talked about this on the show. These, three-pronged attack. Like, we'll push back on buying your stuff. We will go after important companies of yours, and we will withhold important strategic commodities, products that you absolutely have to have. And instead of kind of seeing that signal come from them and be like, all right, we need to talk about this, instead of just, just kind of firing at will against them in this trade war, we just went ahead and went, crazy with 145% tariffs or whatever. So they naturally followed through and like, cool, 100% plus tariffs on you guys. You don't get to get any of these rare earths or magnets that come from them, which means you can't make cars, you can't make, military equipment. Like, so I guess that's how we'll just handle this. And it didn't take long before we were at the bargaining table with them, and we were the ones that reached out to them after we said they would be desperate to reach out to us. Like, it's kind of clear where the leverage was on this the whole time, and still is, frankly. Because even after this latest round of talks with China, they made it clear, like, this reprieve on getting these rare earths is a 6-month deal. And they're requiring a lot of data from their exporters on who it's going to, how much. So they're collecting all the data. Like, they're trying to make sure, like, it maybe doesn't go to certain groups, the same way we're doing with them with chips. So this whole thing has gotten worse, I would say, between us and China since this whole thing started. And the tables have kind of been turned from us thinking we had the leverage to becoming, I think, clear to anyone paying attention that they do. Now, we both need each other in major ways. Like ethane, like, could they make their own ethane eventually? Sure. But for now, most of their ethane comes from us. Like, they need it from us big time. We loosened up giving them ethane while they gave us, these rare earth magnets and stuff. Like, so it's not like we have no leverage. They have all of it. The point being, like, we need each other, and getting into this, massive back and forth tit for tat thing is, we're both just hurting ourselves. So hopefully this will get more constructive moving forward, because neither side can really afford to go all out on a trade war. And I think that kind of extends itself even into, Europe and Japan, because they have all the capital. Going back to the capital war stuff I was just talking about. China is a different story. Like, China can hit us with real stuff because they make it and we don't. Whereas the others can hit us with capital because they have it and we don't. So, all things to consider. I'll finish here with what Luke kind of closed us out. He said, with that said, what's done is done. Going forward, the above, meaning the other stuff I read, means we do not have the leverage consensus things we do, which means there is likely no way to get out of this without some form of yield curve control, dollar devaluation, and or capital controls. Broadly defined, he said Section 899 is a form of capital control. So again, to tie back everything I was just talking about with the dollar, with capital controls, I didn't talk about yield curve control, but we've talked about that plenty. Like, you're going to have to find a way to shove our debt onto bank balance sheets, onto people's balance sheets, onto the Federal Reserve's balance sheet. At the end of the day, capital controls now is very broadly defined. To throw Section 899 into capital controls, that's a very soft capital control for sure. But it to me, it's not a capital control at the same time. So I just thought Luke really kind of captured exactly the way I have felt about U.S.-China trade relations for the last 3 or 4 months in that passage, and I just wanted to share it. And if you don't read Luke, I definitely recommend that. Always interesting and thoughtful stuff. A lot of times outside the box. Very anti-consensus, very useful. And him and Brent Johnson have kind of been on opposite ends of a lot of different arguments over the last, honestly, decade somehow. And we'll have Brent on next week on the show, which will be a lot of fun. And who knows, maybe we can get Luke on before too long after that to discuss some of these things. And maybe we can discuss a little Cleveland Browns football while we're at it. That's all I have for today. Data tomorrow is pretty light. We have UMISH, which is signal to noise ratio is too low for me to really get into, so I probably won't talk about that tomorrow. But I'm sure we'll have plenty of other things to discuss tomorrow. But that's it for today. Check out knowyourriskpodcast.com. Check us out, YouTube, everywhere else you can find us, Instagram, all the places the kids are hanging out on social media these days. You can find us, but we'll check you tomorrow. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.